Morning, sir.
Good morning. Good morning.
Good morning, sir.
Very good morning.
Good morning, sir.
Good morning. Good morning. Good morning.
Morning, sir.
Good morning. Just 1 minute more. Exactly at 11 o'clock I'll start. Okay, it's time. We'll start with, as far as possible, maximum number of problems we'll try to solve. I will solve the questions, and please be attentive, and at any point of time, if you have any doubt, you can ask me. So I hope that you all have taken leave from the bank, and just after 1 day, the exam is there. So if you focus on the numerical parts, the whole day it is going on. More focus on the numerical part, it is easier to score more marks. Not only pass mark, you can score more than 60% in BFM. Because it fetches the 100% mark. In theoretical questions, sometimes the confusion is there, some options are very near, so you cannot guarantee that, but numerical will be giving you 100% mark. So please be focus on the thing. Whatever you know, that will be better to understand and do it. Which you do not know, don't try to break your head about that. Okay, so we'll go. The first question is this. First question is, just read the question. Your bank has investment of government bonds worth 5 crore. The maturity period is 5 years. Face value being 100 with coupon rate of 8%. The bond has a market yield of 10%. The price is now 92. Due to change in interest rate, the market yield changes to 9.9% and the market price to 92.50. So you know here coupon rate is 8% and the market rate is 10% and price is 92 at that point of time. But due to change in interest rate, so interest rates has changed, means it has gone down to 9.90. When interest rate is going down, definitely market price has to go up. So that's why market price has gone up to 92.50. So that is the question. Anyway, the first question is, based on the information above, calculate the BPV of the bond. So how to calculate the BPV? BPV has to be calculated. So here for BPV, we have to find what is the change of price and what is the yield. So change of price, what is the change of price? You can easily find out. So change of price is, now it has become 92.50. Earlier it was 92. So change of price is how much? 0.50. This is the change of price, rupees 0.50 or 50 paisa. This is change of price. Now change in yield, what is the change in yield? Change in yield is, earlier it was 10%, now it has become 9.9%. So yield is how much? 0.10%. So this is the change in price and this is a change in yield. Okay, so 0.10% means, what is the, if you convert it to BPS, how much BPS it will be? 0.10% equal to how much BPS?
10 BPS, sir.
Very good, 10 BPS. So it equals to 10 BPS. That means for 10 BPS, the change in price is 0.50. So BPV, when you calculate the BPV is for 1 BPS. So if for 10 BPS change is 0.50, for 1 BPS, how much it will be? Simply 0.05%. Clear or not? You understand this simple thing? For 10 BPS, pardon? For 10 BPS, price change is 50 paisa. So BPV means for 1 BPS, how much is the change? So if 10 BPS is 50 paisa, for 1 BPS, how much? 50 by 10, 0.50 by 10. So it equal to 0.05 or 5 paisa or 0.05 rupees. Clear? There is no problem in this. This is a basic thing in BPV. BPV is 1 BPS. For 1 BPS, what is the change of price? So you have to first find out what is the change in the price due to this change in interest rate, and find out what is the change in the interest rate or yield. So we have found out that rupees 0.50 is the change in price, which has happened due to change of interest or yield by 0.10%. 0.10 is equal to 10 BPS. So for 10 BPS, 50 paisa. For 1 BPS, what will be the thing? So this 0.05 paisa is the BPV. So BPV is equal to 0.05 for this. Clear? No problem here?
Clear, sir.
No, sir.
Okay. Next second question you read. Also calculate what will be the change in the value of investment for the total investment of 5 crore for per basis point change in the yield. A simple thing. Very simple thing. We have arrived at, for the question 1, we have arrived at that for 1 BPS, 0.05 paisa. Okay, so this 0.05 paisa change is for what is the face value of this bond? This bond was 100 rupees. For 100 rupees face value, the change is 0.5 paisa. So if somebody invests 5 crore, what will be the change? That is the question asking. So for 5 crore, what will be the change? Can you calculate and tell me how much it will be? For 100 paisa, 0.05. So 5 crore, what will be the amount will be?
25 lakhs.
Hello?
25 lakhs.
25 lakhs. This is paisa, 0.05 paisa.
25,000.
So
25,000.
So it will be
25,000.
25,000. This is paisa, 0.05 paisa. So if you multiply 0.05 divided by 100 into 5 crore, it becomes 25,000. Okay, don't make a mistake in that way, because this is for 100 rupees. 100 rupees, 0.05. For 1 rupee, how much? For 5 crore, how much? So it will get 25,000. Okay. Now the next third question. If there is a 0.10% change in the yield further, what would be the change in the value of the bonds? Not bind. This is bond. Change in the value of the bond on the investment of 5 crore. Can anybody calculate? Same. See, from question 2, you can come to question 3. Simple. We know the BPV. So how much it will be? For 0.10%, what will be? If there is a change of further 0.10%, then what will be the investment value? Somebody has answered 12,500. How 12,500?
50,000.
How 50,000? Where you are getting 50,000?
2,500.
See, you are mistaking something.
2,50,000, sir.
Yes. What is your name?
Arvind, sir.
Arvind. Okay, fine. It is 2,50,000. Simple thing. See,
10 basis points.
yeah, it is for 1 basis point. We have got 25,000. 1 basis point, we have got this answer in question 2, 25,000. So 0.10 means it is 10 basis point. So 10 basis point, 1 basis point is 25,000. So 10 basis point will be 25,000 multiplied by 10. So it is 2,50,000. Okay.
So can you repeat from the first question, sir?
Again, first question, where are you? See, we want to do as maximum question possible. If I repeat in that way, then people will be losing the time. If you
Sorry, sir.
joined late, just take the screenshot and I see.
Sorry, sir. There is a delay in entering into the session.
Sir, first, please, in short, please repeat. In short.
Oh, see, in short cannot be repeated. If I have to explain, I have to explain full. It is your loss. So you will be losing 1-2 questions in the last. I have no problem with that. So first question is based on the above information. Have you read the questions? Those people who are asking this to repeat, have you read the questions? If you have read the question, okay.
Yes,
so
sir.
the question says that as per the first question is asking what is the BPV? BPV means for 1 basis point change, what is the market price change? What is the change in the price? Change in the price. So this is the question asking. So we have to find what is the change in price first. Change in price is how much? It has become 90 to 50 from 92. So change in price is 0.50. This is change in price. Change in price is 0.50. Now I have to find what is the change in yield. So interest rate is yield. So market interest rate has changed from 10% to 9.90. So this is change is 0.10%. This change, yield change, we can convert it to BPS. So BPS 0.10% equal to how many BPS? 10 BPS. 1 BPS is equal to 0.01. So 10.10% means 10 BPS. For 10 BPS change in the yield, the price has changed by 50 paisa or rupees 0.50. So for BPV, we want to convert it to 1 BPS. So 1 BPS, how much it will be? For 1 BPS, it will be 50 divided by 10. So it is 0.05 rupees or 5 paisa. This is the first question. Second question, calculate what will be the change in the value of investment for total investment of 5 crore. This question is, we are doing it a bond where the face value is 100 rupees. So for 100 rupees, it was 0.05 rupees. Simple thing. So for 1 rupee, how much? 0.05 divided by 100. For 5 crore, how much? So you have to calculate the 5 crore. For 5 crore, how much? So for 5 crore, if you solve this one, it will become 25,000. Okay, for 100 rupees of bond, the BPV was 0.05. For 5 crore, it will be 25,000. Now, third question asking, if there is a change of 0.10% in the yield, what would be the value of the bond? What is the value of the bond? So we have arrived at in this question too, for 1 BPS, for 5 crore, the change is 25,000. For 0.10 means again it is 10 BPS. For 10 BPS, simply you have to multiply by 10. So it becomes 2,50,000. Okay? Clear now? Now,
Okay, sir.
whatever question I will be there in the next question, I cannot repeat it. If you have only a doubt at the time of explaining, please ask me so that I will see. After completion of all things you are asking, then we will be losing more time because time is only 2 hours. Okay, be careful, be attentive. There is no problem at all. So if you are attentive, then there will be no question of repeating. Okay. Now we'll go to the next one. So these are the things given. Some of the information which are given here, just read it. What are the things given? So we have what are the capital funds and risk-weighted assets have been given, and also total eligible capital has been given. So CET capital given 75, capital conservation of 25, PNCPS PDI 30, out of which eligible PNCPS PDI is 20.50. Eligible Tier 1 capital 95.50, Tier 2 capital available 25, Tier 2 capital eligibility is 2730. Excess of PNCP PDI eligible for Tier 2 is 2.73. Total capital eligible is 122.80. Risk weight asset for credit and operational risk together is 900. Market risk is 100. So these are the information given. Now here you see CET capital bank is having this. All the capital is CCB is given. Tier 2 is given. But that means these are the not actual the bank is having, but what is the eligibility also given? Means these are the eligibility. You cannot exceed more than that as per the eligibility criteria. That 5.5, 1.5, and 2%. That criteria is this. So we have to calculate all these things on the basis of this information. We have to calculate what are the things. So first is minimum CET1 capital required to support credit and operational risk will be how much? So CET1 capital required to support credit and operational risk, not market risk. Okay, so we know that CET1 capital, how much is the percentage? CET1 capital will be how much? As per Basel?
5.5.
Very good. So it is 5.5%. So to support credit and operational risk, what will be CET1? Simple, from the table you can easily answer this.
49.5.
49.5, because RWA of credit and operational risk is given as 900. So 900 into 5.5%. So it becomes 49.50. This is the minimum CET1 required to support credit and operational risk. Simple thing. We are going with a simple thing so that later on some complex thing will come. Maximum additional Tier 1 capital within total Tier 1 capital required to support credit and operational risk will be how much? Very simple question. What is the additional Tier 1? It is asking maximum additional Tier 1.
13.5.
So additional Tier 1 will be 1.5%. So simply 900 into 1.5%. So 900 into 1.5%. So how much is 13.50? Good. No problem here. Maximum Tier 2 capital within total capital required to support credit and operational risk. This is very simple again. Tier 2 will be how much? 900 into how much?
2%.
2%. So it will be 18. So answer will be 18. So first answer we got 49.50. Second answer we got 13.50. Third one we got 18. Okay. So what will be the total eligible capital required to support and create a personal risk? Means 49.50 plus 13.50 plus 18. So it is 50 plus 12, 62 plus 18. 60. How much it is? 80 or 81?
81.
81. So 81 is the total capital to support credit and operational risk. Total of this eligible capital required to support credit as per this we have got, because Tier 1 plus Tier 2 all together we have got 81. Okay. Now next question is minimum common equity capital, Tier 1 capital available to support market risk will be how much?
5.5.
Here the trick is that this is a trick question. You cannot see market risk capital. We know that market risk capital is not calculated as RWA into CAR. This is not the way to calculate. Only credit risk is calculated as RWA into CAR. Okay, so this will be not the thing. Market risk calculate differently. So here the question is a tricky one. What is the minimum common equity capital Tier 1 available to support market risk? So we have CET1. This is CET1. CET1 for credit and operational risk we have how much? 49.50. We have So this now here, as per this, we have CET1 as 75. So if we deduct 4950 from 75, the rest amount will be the market risk. Okay, so how much it will be? 2550. So 2550 will be the CET1 per market risk. So now you calculate additional tier 1 for market risk.
Sir, again you tell me, sir. How will
What
we
again?
get this one 49.50.
49.50 was the CET1 for credit and operational risk. We have
That is
calculated
what.
here. Okay.
Yes,
Now,
sir. Yes, sir.
as I told you, market risk capital cannot be calculated as RWA into the CAR percentage. We have here 75 as the CET1 capital total given. So out of 75, 4950 is pertaining to credit and operational risk. So rest amount will be for market risk. So you have to deduct that 4950 from 75. So we have 2550, which is available for market risk. Same way, you calculate the additional time for market risk.
Yes, sir.
Can you calculate? What is additional tier 1?
In 8th question, it is asked tier 1, not CET1.
Which one?
8th question.
Additional tier 1. It is asking additional tier 1.
Sir, 8th question, sir.
8 questions, common equity capital, CET1.
But you have taken, you have minus from 75, CET1, you have minus that.
Here, this 4th question is CET1. Na? Where is your confusion? CET1 given.
Sir, 4th question is CET1, but 5th question is
can you please
CET1.
repeat? 8th question, can you please repeat, sir?
8th question, total CET1, the bank is having 75. Okay, total CET1 means operational credit and market risk. Now we have calculated in question 4, 4950 as credit and operational risk. So rest amount will be market risk. Na? So 75 minus 4950 equal to 2550. Clear?
Okay, sir. Okay, sir.
Okay.
Clear, sir.
Okay. Additional tier 1.
Sir, here minimum and maximum both are same, na, sir? In this case?
Minimum.
Because total availability is only 75.
Minimum and maximum is not same. Maximum means you can take. Minimum is what is the requirement as per this 5.5, 1.5, 2%. Maximum means you can take more than that also. You can keep that. But what is the minimum is eligibility. That is the eligible. Okay.
Okay, sir.
So this maximum means what is the additional tier 1 will be?
12.0.
Tier 2, see, this is the eligibility. You can calculate the eligibility. Eligibility, how much is given additional tier 1?
25.
No, you read all the information given.
95.50.
No, this is additional tier 1.
And it is 7, sir.
Huh?
Additional tier 1, 7. Market risk.
7? Okay, fine. Okay. So it is given additional tier 1 is 20.50 given. Okay. 20.50. 20.50 minus how much? We have received here 13.50.
13.50.
So 20.50 minus 13.50, that will be the answer. So that will be 7. Right? 7,
we are
right?
subtracting from eligible PNCPs bar PDI.
Yeah.
What is that, sir? That is additional tier 1.
That is additional tier 1 where 30 is the bank having, but eligible is 20.50. So you have to take this from 2050 only. Okay.
Eligible PNCPS bar PDI is additional tier 1.
Yes, you have to remember those things because sometimes they will not give this additional tier 1 or tier 2. Sometimes they will not give, they will give the instruments.
Sir, eligible tier 1 capital is different from eligible additional tier 1 capital.
Yes, yes. Tier 1 is including CET1 plus AT1 is tier 1. Okay.
Okay, sir.
Now, maximum tier 2 capital within total capital available to support market risk. That is maximum tier 2. So, what is the eligible tier 2? Maximum tier 2 capital within total capital. How much it will be? Maximum tier 2 capital within total capital available to support market risk.
9.3 ആണ് sir.
Huh?
9.3.
9.3.
Very good, very good. So 9.30 is the correct answer because 2730 minus 18. So that is the answer. And 18 we have received in question 6. Okay. Now last question. Total eligible capital available to support market risk, how much it will be? Total eligible, here again, eligible capital available to support market risk, how it will be the
41.8.
41.8, correct. How you did it? 41.8?
Summation
Because
of all three here.
either summation of all or we can do 12080. 12080 is the here given total eligible capital minus our that seventh question was what is the total eligible capital required support credit margin. So we can reduce 81 from this. So we'll get 41.80. Okay.
Sir, for operational risk, can we use risk weights to calculate, sir? No problem.
Operational risk sometimes can be used, but see, reverse way it is possible, but direct way it is not possible. Direct way only for credit risk it is possible to use this formula RWA into CAR. This is the only for a credit risk, but reverse way to find out what is that, both operational risk market risk can be calculated reverse way. Means they are asking what is the RWA. For suppose capital of market risk is given 100 and 9% is the CR, what is the RWA? So in this case, we can easily come out 100 divided by 9% will be the RWA for operational risk market. But calculating directly for the capital for market risk operation, this is not the correct way. I understand what is your confusion, why you are asking, because we have calculated this 900 because they have asked here what is the CET1 for both together. Normally question will be not given for this combined for credit and operational risk together. It will be given separately. Here together I have given, so that's why some of the question I have taken 900. But for market risk, you remember it cannot be used that way. Normally in question they will give what is the RWA for credit risk, what is the RWA for operational risk, what is the RWA for market risk. Separately they will give. In that way, there will be no confusion.
Sir, 11th one answer is
Sir,
21.
please explain 10th question, sir. Please explain
10th question. 10th question is maximum tier 2 capital within total capital. So total capital means within total capital means this is according to tier 2. So tier 2 we have an eligibility of 2730. 2730 minus we have calculated that question number 6 maximum tier 2 for support credit and operational 6 says 18. So 2730 minus 18, that will be the answer for that question. Okay?
Thank you, sir. Thank you,
Sir,
sir.
11th one.
Total eligible capital available to support this. So basically we have total eligible capital here 12080. 12080. Either you go and add all the three eligible capital for support markets we have calculated in say 7, 8, 9 or so 8, 9, 8, 9, 10. So in that way we can calculate, or from 120 to 80 you can deduct 81, which is the total eligible capital required to support credit operational risk. So total is here. If we deduct the answer of this credit and operational risk, rest amount will be for market risk. So both way you can calculate. Okay, I'm moving to next question. find out the exposures of borrower's account having the various funded loans from the following table for the purpose of capital calculation. Out of the undisbursed portion of the term loan, as per the confirmed approval sanction of the bank, 60 lakh to be disbursed within 1 year from the date of outstanding available, and the rest will be disbursed after 1 year. So simple thing here, cash credit limit and outstanding is given, bill purchase limit and outstanding given, packing credit has been given, term loan is given. So here we understand that term loan, there is given that as per the confirmation as a 60 lakh to be disbursed within 1 year period and the rest amount after 1 year period. So it is a confirmed section, it is given. So first question is, what is the total outstanding balance to be considered for calculation of capital? This is a very simple question. What is the total outstanding balance to be considered for capital calculation? It is asking about outstanding balance only.
200.
So don't get confused about that term loan adjustment here, because it is asking about the outstanding balance. So outstanding balance is 100 plus 30 plus 30 plus 40. So equal to 200. It's simple. Sometimes for this question, people will do that 20% calculation here and they will say that this is, though that is the adjusted capital exposure or adjusted outstanding. Total outstanding will be 200. Okay. What would be the eligible unavailed portion of amount to be considered for capital calculation for the exposure other than term loan? So term loan, you leave it. You could do this, all these three. What will be the eligible unavailed portion?
28, sir. 160.
Unavailed. Unavailed. Somebody has given the right answer.
140.
No.
148. 28. 28, sir.
Yeah, 140 is the outstanding allotted. So that will be, see, eligible available person other than term loan equal to 20% of limit outstanding. What is the limit outstanding? Unavailed person will be 20%. Nah? Unavailed person will be calculated as total. So total is how much? 160 or how much?
140, sir.
140.
140. Okay, 140 is the outcome. So 140
28
into 20%. So it will be 28. Okay.
Why
Sir,
20%?
I don't understand, sir. 140.
Why you could not understand?
How did you arrive 140, sir?
Okay. So 20% of limit outstanding, that is 20% of what? 20% of limit outstanding. Outstanding means 20% of limit sanction. This, so you can take the balance outstanding. Limit sanction is 200, balance outstanding is 100. So how much you have to take here? 100 plus
100.
20% of 100?
100 in
20% of 100, right? 20.
20.
Here how much you have? 30 plus 20% of 30 is 6. Here 30 plus 20% of 40 is 8. Okay. Is it correct or not? 36. Okay. So how much it is coming? I am doing the correct thing or not? So whether can anybody explain?
The third one, packing credit is
Sir,
10.
question of
2,
unavailed portion only.
last 2 is 10.
Yeah, this is 2. This is 2. This is the unavailed position. This is the unavailed. This is the outstanding. This is the unavailed portion. So 20 plus 6 plus 2 is 28. Correct?
20.
Outstanding, you have to take full. Unavailed portion, 20%. So here, unavailed will be 100. 100 into 20% is 20. Here, unavailed is 30. 30 into 20% is 6. Here, unavailed is 10. 10 plus 20% is 2. So question is asking about this. So 20 plus 6 plus 2 is 28. So This will be the 28 will be the answer for question 13. Okay. Now, next question. What would be the total eligible adjusted exposure to be considered for calculation of capital other than term loan? So simple thing again. We have calculated both the things. So 28 is the unavailed portion and availed portion is how much? 160 up to this. So 160 plus 28 equal
188,
to
sir. 188.
180. So this 14 will be 160 is the outstanding plus 28 is the unavailed portion. So total comes to 188. Clear? Next question. What will be the eligible undisbursed portion for term loan to be considered for capital calculation? For term loan, only term loan. So 40 is the outstanding.
160, sir.
40 is the outstanding.
4 lakh.
You tell me undisbursed portion. So 40 we
62,
have to take. So
62,
64, 64, sir.
62.
How 64? How 64? 160 you have to take, na? 160 out of 160, 60 lakh to be considered for 1 year. So 60 into 20% plus rest amount is 100 and 100.
Total 102.
No, total it is not asked, na? It is undisbursed person asking.
Then 50, 62, sir.
62.
Yeah, 60 into 20%, 100 into 50%. Correct. So it will be 12 plus 50 equal to 62. Undisbursed portion only. Because this 40 it is not asking, is asking out 160. So out of 200, 40 is the outstanding balance. 160 is to be disbursed, means undisbursed portion. Out of which 60 to be disbursed within 1 year, that will carry 20%. And rest amount 100 will be 50%. So 12 plus 50 equal to 62. So 15 answer will be 62. Any confusion? No confusion. Okay.
No, sir.
What is the total eligible exposure on the unavailed and undisbursed portion to be taken into calculation for capital? Total is asking. Simply we have already calculated all the unavailed. This is the unavailed and undisbursed portion. So undisbursed we have calculated at 62 and unavailed we have calculated in that question number 13 we have calculated. So how much of the
28.
thing?
28.
So 28 plus 62 equal to how much? 90. 90 is the unavailed plus undisbursed portions. Now last question, what will be the total adjusted exposure? Means you have to take the outstanding plus this. So outstanding is, we have calculated outstanding as 200 here. 200 plus this is the undisbursed and unavailed. So total will be 290. Clear? 90 for unavailed, undisbursed, and we have to add the outstanding. So outstanding is given in the question 200. All four outstanding is 200. So 200 plus 90 is equal to, this is the balance to be taken for calculation of capital. Okay. Whereas the total limit sanctioned is how much? Limit sanctioned is 500. 200, 200, 400, 500, out of which outstanding is 200. But due to unavailed portion and undisbursed portion, we cannot take 200 as the adjusted balance, but you have to take 290 as the adjusted balance. Clear?
Yes.
If it is clear, then I'll go to next question. Okay?
Yes, sir.
From the available data given by BCA Bank Limited, answer the following questions. Exposures are in crores. Total exposure given for consideration is 26,120 crores. the gross NPA at the beginning of the year in consideration was 16,980 crores. And NPA which is adjusted during the year is 832 crores. And these are the information given. So we have exposure amount, probability of default, PD, exposure at default, EAD, loss given default has been given. So these are the information we have received for this type of advances: corporate, AAA, corporate A, retail housing, retail vehicle, retail personal, and also credit card. And total exposure is given as 26120. NPA at the beginning was 1698. NPA adjusted during the year 1832. Now, first question is, what is the expected incremental NPA of the bank for the year in question? Means, what will be additional NPA for the bank in the current year, which is the question here. This year, how much from this data we have to find how much is the likelihood that NPA will happen. That is called incremental NPA. Means this year how much addition to the NPA will happen apart from this already NPA is there. This is the incremental NPA. So how to find it? I have told it in the theory class when I was taking, explained that also. If you remember, you can do it. Huh?
Probability of default into EAD into LGD.
Okay, so basically, when this, what will be the NPA in this current year, which is going to happen? For that, simple thing is that, what is the outstanding balance? That is called our exposure multiplied by your EAD, means which is the exposure at default. Means out of this is the amount which might go into default, multiplied by how many accounts to be defaulted. So probability of default. So you have to multiply all three: exposure into EAD into PD of all the things. Then if you add all the 5 things together, 6 things together, whatever the amount comes, that will be the incremental NPA. So you have to, this exposure is given here, EAD is given here, and PD is given here. So you can multiply these 3. Has anybody right? So I can calculate here EAD, exposure multiplied by EAD into PD in one column. Then we can calculate for last one, LGD has to be there. So for this we have to multiply LGD. So first one will be 0 because it is 0% is there, so 0. Second one will be how much? 4740.0.5%, 70%. How much it is coming? Can you do something? Somebody can calculate and tell me.
16.59.
16.59. The next one, do it and tell me how much it will be.
37.575.
37.58. Next one, retail vehicle.
Fast. 37.57.
No. Okay. 16. So 37. Which one 37? This retail housing?
136.8.
Are you calculating correct? 37.58 is for what?
62.84.
Which one? The housing.
For retail housing, 62.84.
So retail housing is 62.84. Okay. And 37.58 is vehicle?
Retail
vehicle.
Okay, fine. Then personal, retail personal will be
136.8.
136.80. Next one, credit card
41.25.
41.25. So this is the amount of default which is happening here. So if you add this, total will be how much?
Sir, how you get it this one, sir? 41.25.
Here I have given the formula, na? Exposure multiplied by EAD into PD. So this multiplied by this multiplied by this. This 3 is the multiplication. This one into this is the NPA which will happen in the this current year. This multiplied with this multiplied with this. So you have calculated all these things together. You don't consider now loss given default. Loss given default will be for the different question. So here for probability of default multiplied by exposure default multiplied by exposure amount comes to our NPA. So what is the total coming here?
297.11. 297.11.
295.06.
295.06.
295.06 is the incremental NPA. So answer will be here 295.06. Okay. Always remember, if this question comes, what is the expected incremental NPA? Means how much new NPA is going to happen this year. That has to be calculated by multiplying the exposure amount with EAD multiplied by PD. So basically the formula is exposure multiplied by EAD multiplied by PD. Here the columns are given in this, so you can multiply this into this into this. So this is the amount of NPA coming. Okay, so expected incremental NPA equal to 295.06. Next question is, what is the level of NPA at the end of the year? So after this year, what will be the level of NPA? So for that, we have to find what was the NPA in the previous year. Previous year NPA was 1698. Okay, plus 295 will be the additional NPA minus NPA which has been adjusted during the year. I mean, this is recovered. So minus 832. So equal to how much? 1698 plus 295.06 minus 832.
1161.06.
1161.06. This is the NPA level, NPA which will be at the end of the year. Earlier 1698 was there. Now due to adjustment of this 832 and incremental of 295, we will have 1161.06 as the NPA. Okay. Now calculate the gross NPA percentage of the bank at the end of the year in question. What will be the gross NPA? Very simple. Gross NPA formula is gross NPA percentage formula is gross NPA divided by total advance or total exposure multiplied by 100. So how much it will be? 1161.06. How? 1161.06 divided by 26,120 into 100. How much it is?
4.45, sir. 4.4.
So 9. It cannot be 9. 4.5. Okay. Okay. 11.5. Can you stop? Background sound is coming.
Hello, please mute.
Okay, so 4.45 is the.
Sir, please tell me the formula for question number 20.
Question number?
20, sir, 20.
Gross NPA formula you do not know? Gross NPA percentage equal to gross NPA divided by total advance into 100. You cannot forget the formula at this moment. Tomorrow, day after tomorrow is examination. Gross NPA for percentage equal to what is the total amount of NPA or gross NPA divided by total advance or total exposure multiplied by 100. So we have received 1161 as the gross NPA divided by, this is the advance given, 26,120 is given in the question. So you divide this by this into 100. So 4.45. What is the portfolio default rate of the bank? portfolio rate default means out of the total portfolio bank is having, how much is becoming NPA, that percentage. Simple thing, total portfolio, how much is given is total portfolio is total advance. 26,120 is the total advance. Okay, so 26,120 is the total advance. Of this amount, how much is default rate for this year means how much is turning to NPA this year, which we have calculated as 295.06. So find out the percentage. Out of this, 295.06 is the default. For percentage, you calculate 295.06 divided by 26,120 into 100. That is the default. 1.12.
1.1.
Okay. So this is the amount of portfolio default. Mean this year, this is the percentage of the total advance which is going to be default, or which is turning to NPA. That is the question. Next is find out the expected loss. So for this expected
Sir,
loss,
in this only we will take expected NPA of this year. Portfolio.
Yeah. So normally, what is the portfolio default rate of the bank means it is not about the past NPA. Out of this current exposure, whatever is that, how much is defaulted or how much is becoming NPA for this year? Okay. Otherwise, what is, if you take the everything, that is a gross NPA. We are not calculating gross NPA again. We are calculating the new one. How much new NPA is converted from the total outstanding of loans or exposure. So from 26,120 out of this total exposure, this much is turning NPA. So this is the portfolio default for this year. Okay. Now find out the expected loss. Now here in this case, this loss given default has to be used. Simply we have got this for this all these figures are there. You have to multiply by LGD with each one and sum it. Simple. You multiply this with LGD and sum it, total it. How much is coming? That is the expected loss. So first one will become 0. Second one will become 1659 into 50%. 50% is how much? 8 points. I can take 8.30. Suppose if 1660 I am taking 8.30. Next one 6280. 6280 is 60%. 60% means how much? 50% is 3124 and 10%. 20? How much? 22.55. Okay. The next one?
9.9.
Next one, how much? Again, 60% of this 3758. 3758 are done. Huh? Then 62.
37.70.
37.70.
37.70.
Okay. Next, 136 is 70%.
95.76.
76.
76. Then 41.25, 70%.
28.88.
28.87.
So total it again.
28.88.
Okay. Total it.
193.14.
193.19. Okay. I have added by manually, it is coming. So 193.19. So this is the expected loss. Expected loss formula is exposure multiplied by EAD multiplied by PD multiplied by LGD. Okay, that is the formula. Any confusion? So you have to simply remember what is the question asking and simply you multiply. The LGD will be taken into consideration to find out expected loss only. Other things, PD and EAD to be calculated for calculating NPA. How much NPA it will be there. Okay. Next question. Mixter XYZ company has availed a project term loan from the bank to the tune of 500 lakh for a period of 5 years, payable in EMI. The term loan is secured by collateral worth 200 lakh. If the probability of default as projected by the bank for the term loan is 90%, find the expected loss of this particular exposure. In here, there is no LGD given, nothing given. So you have to calculate that LGD. Exposure is given, PD is given, and your LGD is not given. So in this case, EAD, what is the EAD? What is the EAD? In this case, what will be the EAD? EAD is the total exposure. So EAD is 500. Okay, and PD is given as 90%, or we can say 0.90. PD is given. Okay, now you have to find what will be the LGD. So exposure into EAD is 500. PD is given as this. Now you have to find what is the LGD. How to find out in this LGD in this question? Here, LGD
security.
Yeah. So LGD I have explained in the class. LGD is equal to 1 minus recovery rate. Formula is 1 minus recovery rate. So we have to find what is the recovery rate. What is this recovery? Recovery rate is the percentage of amount which is certain to be recovered from the borrower in case the loan becomes NPA or in case of default. That is percentage of amount of collateral which is available in this loan, and what is that percentage on the outstanding total exposure to what is the percentage. So recovery rate is nothing but how much, if the loan becomes NPA, how much is we can recover from the borrower. So here recovery, we can say that recovery rate is equal to 200 is the amount of collateral. So that is the amount we can recover, out of which
500.
out of 500 we will get 200. So what is the percentage here?
40%.
So 40%. So LGD will be how much? 1 minus 40% equal to 60%. Okay. 1 minus 40%, you can take 100 minus 40 or 1 minus 0.40. So it is 60% or 0.60. Clear or not? LGD equal to 1 minus recovery rate. Recovery rate is the percentage of amount to be recovered from the collateral or anything available. What is that percentage to the exposure? So this is recoverable 200. 500 is our outstanding exposure. So what is the percentage? So 40% is recoverable. That means 60% is not recoverable. So we can calculate expected loss equal to simply EAD 500, PD is 0.90 into LGD is 0.60. So how much it is coming?
270.
270. So expected loss for this will be 270. Clear? In such type question, it will definitely coming. One question will come. So you have to remember how to calculate this LGD. LGD equal to 1 minus recovery rate. Recovery rate is the amount which can be recovered from the borrower. What is that percentage to the loan outstanding? So we have calculated that as 40%. So 1 minus 40% will become the LGD. Means 60% is not recoverable. This LGD is loss given default, means 60% is not recoverable, 40% is recoverable. So 1 minus that means this is not recoverable. So that becomes our loss, which is going to be there for the default, loss given default 60%. So when you multiply all these three together, EAD into PD into LGD, we get expected loss, which is 270. Okay.
Sir, actually, if this becomes, if really this company does not pay, we are losing 300, no, so 300 lakh. What is the significance of this expected loss, sir, compared to that?
Because see, it is expected of, see, straight away you cannot say that 300 will be loss. This expected loss is calculated for the purpose that we have to calculate the capital for that. We can calculate for 300 easily. You can calculate. We can say that 300 will be the loss. No problem. 300, but that way, what more capital will be carried for this? So for that reason, since capital means you have to take it into profit, so it is unlikely that the whole amount will be lost because of the past experience, everything. So that's why some relaxation is given so that you should not carry more capital.
500 is the EAD of.
So see here, EAD is not given means you have to take EAD as 100%. If EAD is given, then you have to take that percentage. When EAD is not given, simply the outstanding becomes EAD. Okay. Here in the question, EAD is not given. If the EAD will be given, say EAD was given 90% or EAD is given 100%, in that case, you can take that exposure multiplied by EAD, then multiplied PD, then LGD. If it is not given, straight away you take that 100% is the EAD. So 500 into 100%. Okay, any other question?
They will not give percentage for EAD, sir.
No, if it is not given, you have to take 100%. If it is given, in the earlier question, it was given, ma'am. So if it is given, multiply that to get the answer. Here it is not given means you have to assume that 100% is the EAD. Okay. Can we go to next question?
Yes, sir. Okay, sir.
Based on the given data of IBS Bank Limited, answer the following 5 questions. Okay. So here capitals are given. Capital 400, bank current account 200, investment, net advances, total asset is this much, and these are cash balances, investment in HFT, HTM, other running assets given. In terms of counterparty, the investment portfolio, so what are the investment made, that has been also bifurcated. So investment in AFS, investment in HFT, HTM, 3 things are there. So they bifurcated that. Government sector how much, others how much, and bank bond how much. So 2000 has been distributed as government sector 1000, bank bond 500, and others 500. Again, breakup of investment at various categories. Okay. In government sector, how much HFT, how much AFS, and how much HTM. So this is 1000. So we have government sector 1000 tallied. Bank bonds 500. So 500 is there, out of which HFT category 100, AFS category 400. Other is 300 and HTM is 200. So 500. So that tallies. Now, other than that, risk weight assets have been has been given. So risk weight of cash and bank balance is 0%. Cash balance with RBI is 0%. Bank balance is 20%. Investment in banks is 22.5 to 50%. Investment in other is 102.50. Investment in government is 2.5. Advances and other earning assets are 100%. So these are the information given. Now you have to calculate. First one, total risk weight asset of IBS Bank Limited is how much? Total risk weight asset. These are the investments. So basically, we have to find out what are the things are there. So normally capital to be excluded because capital is not considered into this. So we have to exclude that one. Now for cash and balance with RBI 200 is there. So for this cash 0% is the risk weight. So for this risk weight is 0. So cash balance risk weight is 0. Investment, so bank balance is how much? Bank balance is 200. So bank balance how much RW? 20%. So 200, 20% is how much? 40. Okay. Now investment, total investment we can take from here because total government sector is given, other given, bank bond is given. So total, whatever the investment HFT, HTM is there, we should not worry about that. We can take this 2000 here. Government sector 1000. So investment in government sector carries how much risk weight? 2.5%. So 2000, say 1000 into 2.5% is how much? 25. Okay. Then bank bonds. Bank bonds how much? Investment in bank bonds is here 22.50%. So 500 into 22.50% is 11.5, 12.50. Okay. Now others is 500. Others is 500 is 102.50. So 102.50 into 5. So 500 1250. Then other than that also net advance is there. Net advance is 200 and other earning asset is 300. So for the 2300 it is 100%. So you have to take that 2300, 100% means 2300. So you can add this 40, 0 plus 40 plus 25 plus 512 plus 2300 plus 112.50. How much is coming?
Sir, where from this 2300, sir?
This here net advance is 200, other earning asset is 300. So together I have taken. So here advances and other earning assets is given 100%. So I have added these two, 2000 plus 300. All has to be taken. So we have taken cash balance, except capital, everything has to be taken. Okay, so I have taken all the things. Rest remains net advance plus other earning asset where the risk weight is 100%. So that becomes 2300. So 2300 plus 112.50 plus 512.50 plus 25 plus 40. How much is coming? That will be the answer for this one. Can somebody add this and tell me how much it is coming?
2990.
2990.
2990. Okay, fine. Now find out the percentage of total risk-weight asset to the book value of the asset. Simple thing. What is the book value? Book value is given here. Total asset is given. Book value is 4,700, and we have find out RWA is 2,990. So what is the book value? 2990 divided by 4,700 into 100. How much?
63.6.
63.6. Okay. 63.60. Fine. Next, what is the capital adequacy ratio of the IBS bank?
How that 4,700?
4,700 here total asset is given. Na? Total asset is given 4,700.
Okay,
so book value is 4,700. So out of that, what is the asset? We have to calculate. Now, what is the capital adequacy of the bank? Capital adequacy is CAR. CAR equal to your capital divided by total risk-weight asset. So capital how much? Capital is given as 400. Na? First one is capital, 400 is given. Okay, 400. And what is the risk-weight, total risk-weight asset? 2990. 2990 into 100. So that is the capital adequacy ratio. How much it is?
13.37.
13.37.
13.37 is the capital adequacy ratio. Next is what is the difference between the maximum and minimum risk-weight asset under investment portfolio? So we have calculated all things. What was the maximum risk-weight asset and what is the minimum?
Maximum net advance.
Maximum?
Net advance.
No. Net maximum was here. Na?
Others.
5 and 12. 0 you have to exclude. 0 you don't have to take here. So 512.50 minus the least one is 25. This one is government sector is 25. So you can take this one as 50.
487.5.
487.50. Okay, this type of question will be asked. So this is about the total investment. What is the RWA? How you are going to find out? This will be given. Everything has been given. Only to confuse so many things have been given. HFT, AFS.
Sir, please tell the last question.
Here,
Last
other
question,
earning assets, no need to continue. Only investment we are doing. 27th question.
Now, other than that, whatever the availability of risk weight is given here, what is the maximum RWA out of all the things? Which was the maximum? We have calculated all the things. Huh? Everything is there. What is the maximum RWA?
It's 2300 we have got for this 100% advertise and other earning assets.
No. Yeah, you are right. You are right. Here it is given under investment portfolio. So net advance and other earning assets are not investments. These are the loans. Okay. Do you get it? So you have to exclude all these things. Only only take this investments. Investment in government sector, others, and bank bonds. So we have three data here: 500, 1250, 100, 1250, and 25. So maximum is this, minimum is this. Difference is this one. This is asking about the investment portfolio only, not about the advances. Okay.
Sir, how that 400, question number 26.
26. 26 is 13.37.
400 numerator. 400 by
Capital, madam.
This is the capital. 400 is the capital. Capital divided by total. 400 divided by RWA into 100 equal to capital adequacy ratio. Here I have written
Bank
capital
bonds.
divided by RWA. Okay.
Bank bonds.
400, how we get?
100.
400 is given in example capital already there, madam.
When?
In question is there, madam.
First row it is there.
Bank bond.
Okay,
Bank bond. What is your question about bank bond? What is your question? Bank bond? Somebody is asking bank bond. What is your question?
How 112.50?
How 112 point? Bank bond, how much it is there? 500 is there, right? What is the risk weight for bank bond? In the table it is given. What is the risk weight given for bank bonds? What is the risk weight given? Can you see in the table?
22.50.
So you can calculate 500 into 22.5% is equal to 112.50.
Okay.
Okay.
Sir, for investment, we don't take that HFT investment and HTM investment.
Now all have taken. These are given differently. So these from other questions, you say market risk thing comes in this question, but such question. So we have to take the total amount only. So total amount is available in this rows only. These three are given. We don't have to take HFT, HFS, and HTM for these questions. It is not required at all. If the question will be different for HFT, HFS, some market risk concept will come, that will be taken into account. Only total investments you have to take. Total investment here, whatever you take here or here, total investment is this much only, 2000 only. Here also 1000 plus 500, 500, 2000. Here also 1000, 500, 500, 2000 only. Here that is differentiated because government sector carries, what is the government sector carries, how much the risk weight, so 2.5% here. Bank bond carries 22.50% here, and others carry 102.50%. So this is the total for which we have calculated. Okay. Next question, same question. What is the capital held by IBS Bank Limited in excess of the minimum regulatory capital requirement? What is the, say, we have got, what is the total RWA we have got? How much was the RWA? In the first question, 2990 RWA. So if the regulatory requirement is 9%, so how much it will be? This will be the capital. So how much it will be? 2990 into 9% is how much?
269.1.
269.10. So this is the regulatory. Okay. 269.10 is the capital to be maintained, minimum capital to be maintained by this bank. But how much capital we are having?
400.
400.
So what is the excess or less?
130.9.
130 plus 9 is the excess amount the capital is. So question is asking that. So in excess of the minimum regulatory, how much? So 130 plus 90, 130.90 is the excess amount of capital which is the bank is having. Okay. Next one is what is the amount?
Sir? Here in exam, without any doubt, can we take 9% or should we think about that total 11% is required, no, including?
No. They will be giving 9%. I have not given it. 9% is given. Okay. They will be giving the 9%.
It will be mentioned.
Yeah, sometimes
If it is
the
not
9%,
mentioned, if it is
not
not
mentioned,
mentioned, then
normally
what should be
100%.
done?
No, normally they will be mentioning. Either they will be mentioning that, or they will mention if you are having doubt about 9% or 11.5%, right? So in such cases, they will say that in excess of minimum regulatory capital requirement, including conservation buffer. In that case, you have to take 11.5. Normally, they will give in excess of the, if the capital adequacy ratio is 9%, then what is the minimum regulatory capital requirement in excess of the thing? So they will be giving the question. Okay. Next one is what?
HFT, AFS and we have to add this, sir. HFT, AFS and HTM for risk-weighted.
Where is the risk-weighted for HFT, AFS given?
First question, sir. First question. HFT, AFS and HTM all we have to add together, sir.
Which question?
First question, sir.
First question is which one? This 28?
No, 26 one, sir. For weighted assets, sir.
No, I told forget about these things. These three things you have to forget. Don't confuse with this HFT, HF. How much investment is there for which sector as per the risk weight? You just focus on that. Do not confuse with HFT, HFS and HTM, because there is no such question in this. What is a HFT for AFS? There is no question, so don't confuse about that. You just forget about this column. This row you forget. Okay? There is no question. What is the amount of asset IBS Bank Limited is having under its banking book?
500, sir.
500. 500.
Held to maturity.
500.
Banking book. Banking book means you are so you have
available for sale. Both.
How much?
AFS plus HTM.
No, only HTM. Only HTM.
Read the question. Read the question properly and answer. I understand.
2,700.
2,700. 2,300.
How?
In table,
HTM has to be taken. HTM is under banking book. Okay, it is not under trading book. Net advance is banking book. Other earning assets are banking book. So, how much is the total? 2,800. Other earning assets. All other assets, including HTM in the investment, they will be under banking book. So, in banking book, HTM category of investment will come. All loans and advances will come, and other earning assets, which are not under investment, they are also to become. So 2,000 plus 500 plus 300. So 2,800 will be the amount of assets which will be classified under this banking book. Last one, what is the difference between the total earning asset and liabilities of the IBS Bank? Total earning asset and earning liabilities. Simple. What are the earning assets given? Make the total. And what are the earning liabilities given? They make the difference. What is the earning asset? Total earning asset given?
300.
4700. 4,700.
4,700, sir. Total earnings.
Total. Okay. 4,000. 4,700 is total assets given. Earning out of which earning asset how much? Cash balance you are earning.
3,300.
How much? 4,000?
3,300.
No. So cash and bank balance 200, and this will not come under this.
4,100 crores, sir. 4,100 crores.
How? Net advance is earning. Net advance is earning. Okay, earning asset is net advance. What is the advance? Then investment under HTM is also and other earning assets.
3,800, sir.
3,800 or 2,800?
2000.
Sir, investment.
Total investment. Yeah, 4,300. 4,300. Okay, fine. 4,300 will be the total earning assets. So these two plus, is it coming 4,300?
3,000 investment AFS.
Yes, sir, 4,300.
3,300. Sir,
AFS,
AFS, net advance, HTM, other earning assets. Total 3,800.
How? 3,000 plus 1,000, 4,000 plus 300.
HFT 4,300. Yes, sir.
Yeah, 4,300 is the earning asset. What is the liabilities? Liabilities, how much liability is there? It is not talking about earning liability or whatever it may. Earning asset is 4,300. What is the liability in this question? What is the liability given?
Capital.
Which item is the liability? Yes.
200.
Only capital. 400. 400 is the liability. Bank current account. This is the current account which has been held by the bank. Yeah.
Sir, how can we get 4,300? Please once more.
Here, see, out of these, which are earning? You tell me which are the earning. Do you earn anything on the cash and cash balance maintained to RBI? You earn anything from here?
No, no, no.
No. So you deduct this one. You investment in HFT. You are earning something or not?
No,
you have
sir.
made investment. No. You have
Yes,
made
sir.
investment.
Yes,
Your investment HTM also you are earning. Here earning asset is written, so we are earning from this also. Now capital is a liability, so we are not considering this as asset. Bank balance, current account, no earning, so this will not be taken into account. Investment AFS earning, advances we are earning. So whatever the ticks are there, you take this one. 1,000, 2,000, 500, 500, 300. These are the earning asset. So if you give the total, it will come 4,300. Liability is only this. Liability is capital. So you deduct this. What is the difference? 3,900. Okay.
Okay, sir.
Clear? Okay.
Okay, sir. Clear.
Okay. Next one. Here, the credit portfolio of this bank has been given. Out of the total credit fund-based exposure is 10,250, out of which AAA rated corporate lending is 4,600. So I will take here outstanding or exposure 4,600. This is for AAA. I am writing in this AAA only. Then A rated 3,400. So this will be 3,400. Unrated corporate loans beyond 1 year period rating 1,500 crore. Beyond 1 year. So it is 1 year. So this beyond 1 year and 1,500. So I'll take 1,500 here. Retail exposure general 750. So retail is 750 given. This is retail general. Then eligible financial collateral. So collaterals are available for funded exposure. AAA rated corporate loan 350. So I will take here eligible financial collateral, next column 350. A rated 250. Where all the eligible financial collateral have 0% haircut and there is no mismatch. That means we don't have to calculate anything for this. Straight away we can deduct this one. 0% haircut and no mismatch in either currency or tenure mismatch is not there. So this is the thing. Now apart from that, we have, this is the funded one, then non-fund based, financial bank guarantee to corporate AAA rated. Again here, exposure is 1,350. There is no EFC. Documentary LC to A rated corporate is 900. Bid bonds to A rated corporate is 150. Okay, these are the non-fund based. So now first calculate the capital. What is the capital charge? You have to calculate. Now, so outstanding is given, EFC is there, EFC is there. So we have to find out what is the total amount to be taken. So 4,600 minus 350 equal to 4,250. This is the exposure we have to take for this funded one. This 3,400 minus 250 is 3,150 to be taken. And here 1,500, there is no EFC, means 1,500 taken, and 750 will be taken. Now, what will be the risk weight? Risk weight will be, for AAA, it is given risk weight is 20%. A is given 50%. This is given as 150%. And retail, how much it will be taken? Retail, for retail, can you tell me how much is the risk weight? Retail general?
75.
Okay. So you calculate what is the RWA for funded. You tell me, you add all these three, tell me this one. 4250 20% plus 3150 50% plus 1500 150% plus 750 75%. How much?
5237.50.
5237.50. Somebody else confirm me whether this is correct or not. If it is correct,
Yes,
then we
Correct, sir.
okay. Okay, fine. If it is correct, then we have got the RWA for funded exposure we have got. Now for non-funded exposure. So in non-fund based, only another thing which to be multiplied is CCF. CCF is given in the question. So for financial guarantee, CCF is 100%. For second one is A-rated. Second one is A-rated. What was the second one? Document. LC. LC, it is 20%. LC is 20% CCF. And third one is 150 is bid bond. Bid bond is 50%. This is CCF. Now, this is the AAA. So 20% is the risk weight. LC, A-rated means 50%. LC A-rated, na? LC to A-rated. Okay. Bid bond was for A-rated, again 50%. So tell me what is the risk weight asset for non-fund based.
Sir, how is the 20% correct, sir? 900 into 20%.
20% is what? LC, na? LC for LC it is given, na? CCF is 20% here is given. For documentary LC, CCF. This column is CCF. This is the risk weight. CCF, we find out financial guarantee CCF is 100%, LC is 20%, bid bond is 50%. Here it is given, all the things are given. So we are multiplying non-fund based with CCF, then we will multiply with the risk weight. Risk weight is according to the rating. So rating is 20%, 50%, 50%. So can you tell me how much it is coming, total of this thing?
7.50.
I could not get it. How
39.5.
It said 42.5 total. Funded plus non-funded.
No, you tell me this non-funded one only. Non-funded.
397.50.
397.50, right? Okay. Now the total you tell me.
5502.5.
5502. 5502.
0.5, sir.
Is this 397.50 is correct, na? Can somebody else confirm me? This is
Yes, sir, that's right.
That's right, na? Okay, fine.
The answer is 635.0.
Huh?
So once you explain 150 into 50% into 50%, 150, 50% is okay. Bid bonds for this one. But getting 55.
5635 answer. 5635.
5635. Okay, so this is the total RWA. Now find the amount of capital if the capital adequacy ratio is 9%. So how much is the capital? 500 something it will come. 500?
507.15.
507.15. Okay. So this is the amount of capital. Now tell me where is the confusion? Non-fund based, why you have confusion?
Last one, sir.
Why 150 is the what? Bid bond to A-rated corporate. Bid bond, what is the CCF? Bid bond CCF is given here 50%, right?
Yes, sir.
50%. So I have taken 50%. Now it is A-rated corporate. So risk weight will be for A-rated. How much it will be? 50% or not?
50%. Yes, sir.
So okay. So you have to in non-fund base you have to take both the things, CCF then our risk weight. Okay. Clear? Can you go?
Sir, collateral should be deducted from that outstanding amount, sir.
Yeah, because here eligible financial collateral has been given where no adjustment has to be made because there is 0% haircut and there is no mismatch in the currency mismatch or tenor mismatch is not there. So full amount we have to take. So you have to reduce that because since these are the eligible financial collateral, then it will be reduced from the outstanding balance to calculate the capital. Okay. Your bank has sanctioned an export packing credit of 1 lakh to my company limited, which is yet to be rated by any external credit rating. So it is not rated. However, your bank has taken ECGC cover to the extent of 75% of this loan. Okay, so ECGC cover is 78%. The risk weight for exposure to ECGC is 20%. Calculate the minimum capital to be provided for this exposure if capital adequacy ratio is 99%. Assume the risk weight for the unrated exposure is 100%. You can do it very simple. So exposure is 1 lakh, out of which this is the total exposure, out of which ECGC coverage is how much? 78%. So 75,000 is the ECGC portion. And 75%, this is the 78%. So rest amount is 25,000. Total exposure 1,000, out of which ECGC cover has been done at 75,000, which carries risk weight. So we take the risk weight here. Risk weight is how much? ECGC percent 20. And rest amount is carrying how much? Risk weight is 100%. So 100%. So if the CAR is 9%, then what is the amount of total capital? So 75,000, 20% and 9% equal to how much? 135. 13550. 259 is 225. 220. 2250. So total will be
3,600.
3,600. Okay. Here you have to calculate in that way. Simple thing. It's very simple question, but sometimes you confuse. So total exposure, ECGC exposure will be taken as 20% risk weight because this is secured. That's why it is not that much of risky. 20% risky only. But rest amount, which is not covered or anything, so it carries 100% of risk weight. So you have to multiply this by 100, this by 20, then 9% is the capital adequacy ratio. So you have capital of 3,600 for this exposure. Clear? Next is an exposure of 1050 is backed by financial collateral of A plus debt security instruments of 600 crores. So 1050 is the exposure. So this is the exposure and this is the EFC. EFC is 600 crore, which is issued by others. The tenure of the exposure is 3 years. So this is given, loan is given for 3-year period, while the residual maturity of financial collateral is 2 years. So there is a mismatch. So there is a tenure mismatch. Because loan is given for 3 years, eligible financial collateral is available for 2 years. Okay. There is no currency mismatch. So HFX equal to 0. The available haircut on the collateral based on residual maturity is 25%. The haircut applicable to debt securities. So here haircut is 7.5%. Okay. So this residual maturity thing for 10-year mismatch, we know the formula T minus 0.25. So that is 28% given. Okay. Now we have to calculate what is the net exposure. So here for this EFC, what is the haircut adjusted exposure? EFC we have to. So haircut adjusted collateral, which is C asterisk equal to your collateral amount multiplied by 1 minus HFX minus haircut. So C is how much? 600 into 1 minus 0 minus 7.5%. 7.5% means 0.075, right? I take 7.5%. So equal to 600 into 7 means 92.50%. So how much it is? 600 to 92.5% is how much?
555.
Huh? Pardon?
555.
555. Okay. Now we have to calculate what is the P. P is the tenure mismatch. Again, you have to find out what is the haircut adjusted after tenure mismatch. So it will be how much? 555 multiplied by T minus 0.25 by T minus 0.25, where the capital T equal to how much? 555 into 2 minus 0.25, 3 minus 0.25. Small t is the tenure of EFC, capital T is the tenure of exposure. So what is the answer here? 555 into 2 minus 0.25, 3 minus 0.25. What is the amount coming?
$353.1, sir.
353.18.
353.18. So this is the haircut adjusted collateral. So what is the net exposure? Net exposure will be 1050 minus 353.18. $82. 696.82. Okay. So this way you have to calculate. No problem.
Sir, what is P, sir, here?
P means that, see, P is I have taken for that. Again, haircut. See, first we have calculated haircut adjusted collateral. Next, since there is a tenure mismatch, so that is the final haircut adjusted and tenure mismatch adjusted collateral. This is denoted as P. Okay. Either you can calculate directly. See, normally the formula is given as C asterisk equal to collateral as eligible collateral minus 1 HFX minus HC multiplied by maturity factor. This maturity factor is nothing but this amount which arrived into this T minus 0.25, this 25. This next step is P. P is I have taken this X or C asterisk multiplied by this. Okay.
So we have not taken the 25% anywhere.
So that is given, not 0.25. T minus, what is this 25? This is constant always. The 25. Here it is given. If it is not given also, you have to take the 0.25, which is the constant formula.
The net exposure, sir.
Net exposure means what is the loan amount minus what is the eligible finance collateral. So what is the loan amount here? What is the loan amount?
1050.
1050. Whoever asked the question, why he or she is not answering? You have to answer. You are asking question when I'm asking you to answer, you should answer. And what is the EFC? Haircut adjusted EFC, how much you have got?
555, sir.
So, 558? 353.18 or something.
1.8,
right?
sir. Yes.
So this is the EFC adjusted. After tenure mismatch, this has come. Before tenure mismatch, 555 something here. So when you deduct the eligible financial collateral from the exposure, that becomes our net exposure. So net exposure means this is the amount to be taken for calculation of capital. Okay. Next question. Calculate the minimum capital required for the meeting operational risk under basic indicator approach. So basic indicator approach, we have to find average of 3 years
Last 3 years.
income multiplied by alpha. Alpha equal to how much?
15%.
So you have to find out what is the gross income. So here net profit has been given. So from net profit, we have to calculate what is the gross income. So there are some adjustment, plus or minus has to be done. So we know that provisions has to be added or deducted. Provisions has to be added with net profit or deducted? Added. Sale of fixed asset?
Subtract.
Deducted. Staff expenses?
Added, sir.
Added.
Because these are the operating expenses. Other operative expenses, again, it has to be added. Insurance claim received?
Added.
Minus. Deducted. Other non-interest incomes?
Added.
No. Added. Non-interest income. Okay. Legal claim received?
Deducted.
So you have to you can write this plus minus and do the gross income. So 3 years gross income you can find out by adding with this plus or minus. Tell me what is the gross income for 2016, 15 and 14.
Sale of fixed asset and insurance we have to deduct.
Why to deduct? You have not read the book, or when I explained in the class, because from net profit to arrive at gross income, there are some adjustment where operating expenses, provisions, etc. to be added. Any extraordinary income or irregular income which are not banking income, that has to be deducted.
Okay, sir.
Okay, so your sale of fixed asset is not an income from banking transactions. Legal claim received is not a banking income. So insurance claim received is not a banking related thing. So such things should be deducted. So that's why we have deducted this, and this. And apart from that, another thing here which is not given, always remember, profit on sale of HTM category of investment. If there is any profit which is there, that has to be deducted. And if there is a loss on sale of HTM category, that has to be added. So this two also you remember. After that adjustment, you have to find out. So what is the 2016 gross income? 1060?
1060.
Okay. 15 will be?
1340.
1340.
1340. 14 will be?
1834.
1834. Okay. Add it.
34.
Add it and divided by 3.
1411.
1411.
Okay. 1411.
No, sir.
After dividing 1411. Okay. 1411 is the average gross income. So you have to multiply it by 15%. So how much?
2116.65.
So this is the amount of capital required under basic indicator approach. Okay. Any doubt on this?
Why we add a non-interest income, sir?
Because it is a in income. It is a income, non-interest
So
interest
usually
income.
income is we shouldn't deduct expenses as added and income should be deducted in.
Where it is written. If suppose you are confused with this, if see normally interest income and non-interest income to be added, it is given. So normally this will not be given in the question because only those things which are to be adjusted as per the Macmillan book that will be given. Non-interest income is also a part of income, so which is not added to the net profit earlier. So we have to add this one. Okay. Sometimes sometimes interest income and non-interest income will be given. So in that case, you have to find. Sometimes the thing will be given total interest income, total non-interest income, and total interest paid. Net profit will not be given. In that case, you have to add these two minus this interest paid. That will become your net profit. Sometimes this type of thing will be given. Okay. Normally, questions will be come from the Macmillan book thing. Whatever the plus minus is given, this other non-interest income is not given in the book. So you are confused for that. Other things you will please remember. Now this problem regarding capital conservation buffer and profit distribution. So here, two banks are there where their CET1 has been given. What is the CET1 percentage and what is the net profit after tax and provision is given in this thing. Okay, and these are the RBI guidelines. Now, the question is asking, first question, how much the corporation bank can distribute as dividend out of their net profit to ensure compliance of Basel III norms. Okay, so as per compliance, as per the Basel III norms, if the banks are having this type of CET1, according to that, these are the conservation they have to make the profit. Conservation means they have to maintain, they have to keep that rest amount they can distribute. So Corporation Bank has got a CET ratio of 5.75. So it falls under this category, 5.5 to 6.125. So it is 100%. Means 100% has to be retained as profit, means 0% they can distribute. So for Corporation Bank, question 35 will be, they cannot distribute anything because 100% is the capital conservation. They cannot distribute anything as earnings because they fall under 100% category.
Sir, in question RBI guideline will be there?
Yes, this table will be given because it is very difficult to by heart all these things. Syndicate bank is 6.50. 6.50 falls under second category. This 6.125 to 240. So it is 80%, means 20% they can distribute. So 20% means 1200 into 20%. So that is what 240 can be distributed as dividend. Okay, simple question, 1 mark question can be asked for this thing. Very simple thing. You can just see that these percentages are the thing which has to be conserved. You cannot distribute. The rest amount can be distributed. Next one. The following table gives, read the question. These are the rating migration. Okay. So March 19, on March 31st, March 19, these are the ratings. These rated borrowers were there, which has migrated to different ratings as of 31st March 2022. So AAA, all the things are given. So here it was March 19 figure. Now out of this, how much they have distributed, either upgraded or downgraded into different ratings, that is distributed in this total rows. Okay. Now you see, first question is, what is the percentage of AAA rated borrowers that remained at the same rating level during the observation period? So you have to compare. Yeah. So you can see easily. So in 37, how much percentage of the AAA. So 100 was there. Out of 100, now in March 2020, 70 are there. Out of this AAA, 70% is still continuing with AAA. That means percentage is 70%. So we can say that 70% of the earlier AAA still retained in the AAA only. Okay? Any doubt on this? Next question, what is the number of AAA rated accounts as at the end of the observation period? Means as on 31st March 2020, what is the total number of AAA?
80.
80.
80,
70, so 70 plus 10 equal to 8. 70 plus 10 is 70 plus 10 becomes 80. So AAA is 80 at the end of March 21.
So AA plus is also AAA.
Pardon?
Plus AA plus is also AAA.
No, what is your question?
90.
Sorry,
See,
sir.
out of what is your question?
Sorry, sir. Understood.
See, here March 1900 was there. Now it has become 70. Rest 30 has been downgraded to these rates. Okay, here AA plus 100 was there, out of which 10 has been upgraded to AAA. 60 remains in AA plus. Rest amount again downgraded. These are the things which is showing in this entire columns and rows. Okay. So do you understand this 38 question? There is no problem because 70 plus 10 is 80. Now, third question, what is the percentage of migration of borrowers from rating A to BBB to default category?
6%.
A and BBB to default category. How much A has been defaulted and BBB has been defaulted? Percentage. How much A have been
10.
defaulted to the default category? A
2 and 20%.
5%. 14%. 14%.
So A earlier it was
8%.
200. Now it has become 4. Right? So 204. How much is the percentage? 2%.
2%.
Now for BBB, 400 was there. And how much?
20%.
80. So it is
20%.
20.
So for A, it is 2% default category. BBB, it is 20%. Clear? What is the first?
Shouldn't we do 84 of total 600?
No. They will not. They will not add that one. This question is, they will ask only one thing. I have given two questions together. It is not to add together. Okay. What is the percentage of migration borrowers from rating A? Same thing. Huh? We have done it. A to
Same.
same. Okay. What is the total number of borrowers in the default category at the beginning and at the end of the period? At the beginning, how much, and at the end, how much?
At the beginning, it is 0.
96. Very good. So at the beginning, there is nothing, so it is 0.
And at the end,
At the end, it is 96.
96. Correct. Okay. Simple things these are. Now, calculate the percentage for migration of AA plus loan to AA rating. Means AA to AA is AA plus to AA means it is downgrade. What is the how much?
14%.
Okay, 14% means 14 has been downgraded out of 100, so 14%. Good. What is the percentage of BBB category that did not change their rating during the observation period?
Sir, 18%. 42.
How
42.
18? How 82? 18?
60%.
60%.
42.
60% only, sir.
For question number 82.
Not 82, 42. But how? This 4 has come from AAA. It is asking from double A. You do,
Okay,
you,
sir.
you cannot plus it because it is
Okay,
asking
sir.
about how much double A is.
Okay, sir. Okay, clear.
Now the triple B, percentage of triple B category loan that did not change.
60%.
Triple B.
60%.
So 240 out of 240 remains. So 240 out of 400 equal to 60%, right? Okay, very good. What is the percentage of A category loan accounts that were upgraded to A plus category? A to A plus.
10%.
10%.
10%. Because 200 was there and 20 has been upgraded. So 10%. Okay, clear? There is no confusion. Such simple type of question will be there, but it is very tricky at the, say, you are hurrying through all the things and sometimes you make mistake. Now, IBS Bank has made an investment worth of 5 crore. The maturity period of bonds are 5 years. 5 crore is the investment made, 5 year. Face value is 100 rupees, face value. The coupon rate is 8%. The bond has market rate is 10%. We have done this, or what?
Yes, sir.
Yes, sir. Very first question.
For BPV, we have done, I think.
Okay.
Yes, sir. Same question.
Already. So now this one you do. If the daily volatility of a security is given at 2%, how much would be its monthly and yearly volatility? Assume month has 24 days and yearly has 250 days. Daily volatility is given as 2%. 2% is equal to, say, 0.02. Daily volatility is given. Daily volatility is given. Find out monthly volatility and annual volatility.
Monthly 10.
9.79 for monthly.
9.79.
Okay, monthly is coming 9.80. Okay, and yearly 31.6.
250.
So basically, you know, this is simply 0.02 multiplied by 20 square root of 24 and 0.02 multiplied by square root of 250. So this becomes this and this becomes this. Okay. Because it is square root of t. So your daily volatility into square root of t. That is the formula of arriving at what is the monthly or annual volatility. Okay. You remember this formula? Simple questions will be asked. If per annum volatility of a security is given at 40%, so 0.40. The number of trading days per year is 250. Find out the daily volatility. So you have to find out what is the daily volatility. So it is given as 240. 40 divide, here we have to divide by here 250. Equal to how much? That will be our daily volatility.
2.53.
Sir, if it is not given as 250, number of trading days, sir, shall we take it as a 365?
Yes. No. For VaR calculation, this type, any volatility question, VaR calculation, if it is not given for annual thing, you have to take that year has got 250 working days. Always you have to assume that working day, because Saturday, Sundays are not taken as trading days. So always for VaR and volatility question, 250 is, if it is not given, you have to take annual as 250. Normally for monthly, weekly and other things, they will give the days. Normally for annual thing, they do not, sometimes they don't give the days. So you have to take 250 only. If you take 365, it will be wrong answer. Always remember, volatility and VaR question, you have to take 250 working days.
What about monthly, sir?
Monthly they will give. Monthly, weekly, half yearly they will give. Normally half yearly they don't give, because we have to consider that it is 125. Monthly always they will give, either 24 or 25 they will give.
So why we are dividing, sir? Why we are dividing, sir, instead of multiplying?
Same formula I have given. See, daily volatility equal to whatever your volatility into this square T. Now here we have to find what is the daily volatility. The earlier formula was what for this, what is the formula? Monthly volatility will be equal to what is the daily volatility? Daily volatility multiplied by square root of T. This was the formula. Okay. So for monthly, we are calculating as daily volatility into square root of T. Now here per annum is given. That is here per annum is given. So here 40% equal to daily volatility into square root of T. So daily volatility equal to 40% divided by square root of T or not? Here a question is asking daily volatility. Reverse of this question. Do you understand? So when formula is this, so you have this annual volatility and you know this how many days are there. So find daily volatility equal to 40% divided by square root of T. Last question. IBS Bank has invested 5 crore in shares of Messrs. IIBF Limited. The daily volatility is given as 1.5%. At 97% confidence level, find out what is the daily VaR, weekly VaR, and VaR for 64 days, where Z value of 99% confidence level as per normal distribution is 1.90. So the question is, okay, can you do it?
So probability for 97, but the table given for 99.
99%.
Yeah, that's what I was looking at. I could not see this one. You take this 99%.
So for 99%, it is 2.58, I think.
Then take it 97. 2.33, I think 99%. So 97. Yeah. You take. I think this is 97. You take this 97. They are type mistake.
Sir, above 95, it is 2 points, sir.
Okay. Whatever it may be, you take 95 or whatever. You take 1.90 only. Forget about this. So some type mistake is there. You take the Z value as 1.90. Do it. So what is the VaR percentage? You have to first calculate. VaR percentage is volatility multiplied your Z value or probability. So what is the volatility given? Volatility is given as 1.50% multiplied by Z value is 1.90. So how much it will be? 1.50 into 1.90 equal to 2.85%, right? 2.85%. Okay. So the VaR amount will be how much? VaR amount will be 5 crore multiplied by 2.85. So how much?
1425.
14 lakh 25,000. Okay. So this is the daily VaR amount. This is a daily VaR amount. Now find out the weekly VaR amount. Weekly VaR amount, take that weekly VaR amount is 5 days per day. Weekly VaR amount is 1425,000 multiplied by square root of 5. Assume that week has 5 days. Then for 64 days VaR 1425000 multiplied by square root of 64.
So how do you say it is 5 days? If it is a week, it should be 7 days, no?
No, here it is not given. Saturday, Sundays are not taken. It will be given. So don't worry about that. It will be given. Weekly, assume that week has got 5 days. They will be giving.
Excluding Saturday, Sundays. Okay.
Saturday, Sunday in the world over, there is no trading takes place. So normally the treasury of each bank is closed on Saturday, Sunday. That's why weekly 5 days, and that's why yearly 250 days is taken. So what are the answers? 1 to 5 square root of 5%. What will be the answer?
31.86.
31.86. And this one? 64.
114.
This one 3186 lakh. Okay, right. This is 114,000,000, right? 1 crore 14
Yes,
lakh
sir.
something. Okay, okay. So these are the answers. Okay. So that's all. We have exceeded the time. So thank you very much.
Sir, one doubt,
and all
sir.
The
Sir, in balance sheet management, there is a question called rate sensitive asset and rate sensitive liabilities.
That we'll do it tonight. Rate sensitivity, RSA and RSL. What is your doubt?
Yes, sir. See, they are giving the components of balance sheet like cash, credit, term loan, cash balances. They are asking find out the rates, that is interest rate risk affected by interest rate risk. These assets and liabilities are there. So you find out what are the assets which are affected. Like they say, like cash, credit is all affected. And
so what is your question? What is your question?
No, how to identify the rate sensitive assets? Like if they are giving, or because in the book it is not mentioned like how it will be affected.
Simple. This is simple logic. Asset and liability items, you know, balance sheet management.
Yes, I know, sir.
Chapter.
I know.
You know,
I know.
So cash is a asset or liability?
Cash is asset.
Asset. Okay. Whether cash, which your bank is holding cash or holding in the RBI, whatever it may, do you earn anything from this asset, or do you pay some interest on cash?
No.
If cash is held by your bank, cash in hand, you earn something on cash?
No.
By holding cash?
No, sir.
No, no. So bank's cash in hand has no interest application at all. It does not earn or does not pay anything for the cash. So this is non-sensitive asset. Okay, like current account. Current account is an asset or liability?
Liability.
Liability. So current account, do you pay any interest to the account holder?
No. No, sir.
So this is non-sensitive liability.
So you mean to say that any component which is having interest rate is a rate sensitive, which is not having any interest rate is non-sensitive.
Right. Where
suppose cash credit is having interest rate, whereas cash component is not having any interest rate.
Simple logic. Whether you are earning something on it or you are paying something on it, you bifurcate that way. Current account, you are not paying anything. Then cash, fixed asset, you are earning on anything. Asset is there. So that is also non-sensitive. So like this, where interest application of interest, see this RSA, why it is divided, any change in interest rate will affect our net interest income. So for cash and current account, there is no change. If there is change, this is not affected. So they are not rate sensitive. Okay.
Okay, sir.
Sir, once explain the HFT, HFS, sir.
What HFT, HFS?
We have to add those one, no, sir. Net advances like this. Once you tell me which one is added and which one will be deducted.
Profit on sale of HTM category, not HFC. Profit on sale of HTM category assets to be deducted. Profit deducted, loss added. That's all. Profit on sale of HTM category investment to be deducted, and sale on loss on sale of HTM category investment to be added. Okay.
Sir, in operation risk, that beta factor is continuously changing, sir. Like average of gross profit for 3 years into beta factor 15%. Whereas in other cases, it is differencing like 12%, 15%, and 18%.
Standardized. Not other cases. See, you have not read. Basic indicator approach alpha is 15% always.
Operation risk.
Yes,
Yes,
we are
sir.
talking about
Basic,
operation.
yes.
Basic indicator approach, that is alpha. Then next standardized approach is beta. Beta is 12, 15, and 18. 3. It is decided as per the 8 business line. There are different business line for which some are attracting 12%, some are 15%, some are 18%.
So how to identify in the question which percentage we have to calculate?
No, they will give, you cannot remember 8 business line. If you can remember, then you can score 100 in the BFM. You cannot remember, they will be giving all these things. Which business line has got what?
Currency mismatch, if he did not give, we should take 0 only. Or 0.08 something you have told in class.
If there is a currency mismatch, then HFX is equal to 0.8%. Simple 8%. 8% equal to 0.08. If there is a currency mismatch, then it is 8%. If there is nothing, 0. Simple flat rate of 8%. That's all.
If he did not mention anything about that in the question, then what we have to do?
What they will mention? You tell me.
Sir, in the book, sir, in the book, there is a 4-5 pages collateral haircuts they are given. So we cannot keep on memorizing for all those 4 to 5 pages of each and every component. They are having percentage.
No, you don't have to. I told you, if you can by heart those things, you can score more than 100 in BFM.
Sir, normally the collateral variation is 0 in most of the cases, whereas maturity and this affects also is 0.
Everything will be given. Whatever thing will be there, it will be given in the question. You please apply that one. You don't have to read those annexes, deep blue color annexes. You don't have to remember. If you can remember, then you can become the head of examiner for CAIIB. It is not possible to remember so many things. Okay.
Maximum.
Everything will be given. That haircut for this security is how much they will give, and they will give the what is the HFX, whether there is a currency mismatch or tenure mismatch. It will be given. You have to follow that, and you can answer the question. You cannot remember all the things. Okay,
sir. And sir, one last question, sir. Sir, in a book, actually risk management is concerned. They are asking so much of problems, sir. Whereas in Macmillan book, there is a lot of theory in it. Whether it is necessary, both the theory has to be read before going for the exam, because I have already read the full module, but sometimes due to paucity of time, I'm not able to revise or something. So whether it is mandatory that theory part also in risk management is equally important for attending the exam, or else numericals will be happening.
It is a question of, say, suppose you are playing cricket, whether you will practice for 1 month, then you straight away go to match, or without practicing you go to match. So what will happen? If you have continuously practicing for 3 months, then you go to play the match, then definitely possibility of scoring more runs is there. If you do not practice, you sleep at the home for 3 months and you go and face the bowler, you can get out with 0 also. I hope you understood my answer. Okay. You practice, the concept will be clear from theory. After this, numerical can be done. So if you read everything, that is fine. If it is not possible, whatever you have read, if you concentrate on that, that will also make you pass the examination. Don't worry about it. It is not possible to anybody to entirely read the book. So whatever that's why the classes are there. You are attending the classes where some clarity will come. Conceptual clarity comes from the attending the classes, because some things we read, we cannot understand those things. So whatever you read, that is more than enough. Don't try to cover 100%. Which are not done, not done. You don't have to score 100%. You are supposed to score more than 50%. So you don't have to read the full book. Okay. See you.
Okay, sir.
See you in the evening, 7:30. Balance sheet management will do.
Thank you.
Thank you. All the best. All the best for the examination. All the best.
Thank you. Thank you very much, sir.
Thank you very much, sir.
Welcome.
Next section is 3:30. Okay.
Please, sir, kindly share PPT now. Problems.
Thank you, sir.